Hi, how's everybody? Hello,
Professor.
how are you,
Good
Yante?
afternoon, Professor.
Ying Yu, how are you? Only two people responding. What happened to the rest of the class? How
Good evening, Professor.
are
Good
you?
evening,
Good evening,
everyone.
Ophelia. How are you? Good
Fine,
evening.
thank you.
Okay. I see one more person is joining, Kwang Lee. So we have 9 people actually. Only in the collaborate, okay? But in before I before I came to collaborate in the it's 12, I mean 11, except myself, 11. Um, okay, so well, today is the last day, right? Uh, and you have only the final left, and the final will be available. Uh, I think it's already available, isn't it? Let me just quickly check. Yeah, final is already available. So it's due Saturday. Um, so that's the last exam. Quiz 2 is already over, so I'm a bit behind. I'm gonna have to update this, and you will see the update together with the final. I'm not gonna just update only one. Um, so uh, as the collaborate session is mainly for reflection, right? Reviewing and reflecting, and we have 2 topics left for reflection, and which one is, which is basically, stock valuation and the second part of risk and return. But quickly, I would like to talk about. Uh, oh, what is? Yeah, okay. Sorry, I'm not sharing anything just yet. So let me share my screen. I just noticed Ophelia just typed into chat box her greetings and nobody is greeting back. Huh? How come you guys are so uh, that's rude, huh? If you're not anyway, so I'm sharing. So yesterday we found, basically we found our mean return and we found our standard deviation. Now the standard deviation is, in a way, it's average deviation from the mean. So then how does that help us? Well, first of all, if you think about it, deviation from the mean, in other words, deviating from the mean is the risk, right? Because a stock that has, wide variance, meaning wide standard deviation, right? A stock that has wide standard deviation uh, is clearly more, riskier stock than uh, it's riskier than uh, the stock that has smaller variation, right? Doesn't that make sense? Because if it is fluctuating wildly, right, Risky means also there's it's not only a bad thing. If it is, because risk is not only a downside. When we say risk, it sounds like a downside risk. It means downside. But let's think about it. The concept of standard deviation is something like this. So this is the mean, right? Let me. And in our example, in case of Apple, the mean was like 3 point something, right? The mean return was 3 point something. And what was the standard deviation? 8 point something, right? Yeah, let's call it 8.23. Um, so I wish I could draw here, but it's maybe I'll try drawing right here. So now think about it. So this is the distribution of Apple's return, monthly returns. And in the middle, the mean of the distribution is Greek character. Symbol is Greek character mu. So to write mu. And in our example, it was, in Apple, it was 3.36. Okay, let's see. All right. And also that 8.29 is our standard deviation, meaning Greek character sigma is the symbol for standard deviation. This is one standard deviation above mean, and this is one standard deviation below mean. So it's kind of negative, right? Because it's below mean. It's not necessarily negative number. And it's 8.29. That's not 8.29. Actually, if you think about it, if you think about it, this is 8.29. I mean, from here to here, this distance is 8.29. And this is also 8.29. Right? So it's 8.29% above and below the mean of 3.36. So then this will have to be what? This point is actually, but this is actually 11.65, and this point will be, okay. Let me use, no, I'll just have to bring it back there. Okay. So that's one standard deviation above mean, right? 11.65, that point. And negative 4.93. And another one standard deviation above mean will be, so this is another one standard deviation, right? So it's actually two standard deviations, right? From above the mean, right? And then this one, another one standard deviation below mean, right? Then what's this point going to be? Is this one plus another 8.29, 19, and this one, this point will be oh, come on. K37, right? Minus another 8.29 will be 13.22. So 19.94. That's the point where the return is two standard deviations above the mean and negative 13.22. This is the point where it's two standard deviations below mean, right? And statistically, what is the meaning of all this statistically? Well, statistically, right? If all assuming normal distribution, meaning basically most of the data we find, most of the data uh, in social sciences are, and natural science as well, natural sciences are normally distributed. And of course, normal distribution is only one type of distribution. There are, many other types of distributions. There's uniform distribution, and there's, binomial distribution. There are, you know, chi-square distribution. Log normal distribution, Poisson distribution. There are many types of distributions. Uh, but not dozen, not dozen distributions, but usually within about 5, 6, types of distributions. But normal distribution is the main thing, right? Normal distribution is the main thing. Now, and this is a random data, right? All these returns are were assumed to be randomly happening. Of course, it's not completely random because this is a sample, meaning the returns are in our example, the returns have upper. Remember, we did it yesterday. If you think about it, over the last 5 years, right, the monthly returns only ranged between negative 18.440 and 21.44. So it ranged between this. So it's not completely, random. It's within this range, random within this range, right? That's why, remember, loss of 1 degree of freedom, because it's not population but sample, because uh, uh, the range is, obviously, uh, uh, limited by or constrained by the randomness is constrained by the range of the returns over the last 5 years only. Now, then our but assuming we understand that it is uh, random variables are variables are generally normally distributed. So we take normal distribution assumption, right? We will assume normal distribution. And when normal distribution is assumed, uh, it will take on normal distribution properties. Of course, this is called central tendency. There will be more of the data, the random variables, that will be centered around the mean. There will be more. And how more? How much? Um, within one standard deviations around the mean, within one standard deviation around the mean, in other words, between negative 4.93% and 11.65%, right? Uh, oh my God. What? So within this range, right? Okay, 68% of the data of these returns are distributed or lying within uh, uh, one standard deviation uh, around the mean. Okay, uh, but that's not the correct way to say that. Actually, the correct way is actually there's a 68% probability that these, data points are uh, distributed within one standard deviation around the mean, right? So if this is 68%, what's the rest of, where is the rest of, and what is the probability of the rest of them? The rest, of course, everything is 100%. Out of 100%, if 68% is here, then the rest of them will be 32%. Isn't that right? 32%. Right? So that's what it means. Half of them is 34, right? So the rest of them will be, which is, if it is 68, 38%. And half of that, 32%, will be lying here, and the other half will be lying in this area. And of that, so half of that will be, um, so then half of it will be 16%, and the other half will be 16%, isn't it right? So of the 16%, 14% is lying between one standard deviation and two standard deviations. The other 14% also one standard deviation and two standard deviations below mean. Okay? And that's, 14, 14, 28, right? So there's 4% left. The other 2% is lying outside two standard deviation, lying outside, two standard deviation. So, in other words, give me a break. There's 14% here, and there's 2%, out here. So that means, think about it. Altogether, I mean, within two standard deviations around the mean, that is like 96%, right? 96% of the data are within two standard deviations. So and that gives us, that gets us, so the idea is, these are called, tail area, right tail, left tail. If if 19, if you are above, I mean, the return is above 19.94, then that belongs to this 2% probability, upper 2% probability. And if the return is below negative 13.22, then it's also very, low probability of 2%. And the data that falls in this range they are called outliers, because it's an outlying area, which is, very rare area. Again, if we sorted it, this way in descending order yesterday. So what is greater than? There's only one occurrence that happened, in that upper 2% upper tail, right? It happened only once. That means it had this 21% return, 21.44% return, beat that 2% probability. That's a very rare probability, and it beat. And also below 13 point something, only, also one happened. There was only one occurrence. So it's that rare. Out of 60 data points, only two were outliers, right? Out of 60 data points, only two were outliers, and the rest of them, 58, all fell within 96% probability range, or right, 96, two standard deviations around the mean. So this is how you interpret it, right? And also we can assign some probability of what, for example, if your expected, this is the expected return, mean return is the expected return, but let's say you want to, what is the probability of, I mean, if your target return is 15%, what's the probability of, right, getting 15% return? Well, of course, 15% will be in this range, and it's within this 14% range, but the probability of, between 14 and 15%, it can be the probability of that earning between 15 and 14% can be also nailed. It can be nailed down, right, with probability. Okay, so that is, basically what we can do with the mean and standard deviation in connection with the normal distribution. Another thing it can help us is by looking at the why is this so big? Okay, I told you also the standard deviation is the risk, right? Because nobody wants, but it's a risk is also an opportunity. Think about it. This distribution shows, stock that has, very small variance, right? Small standard deviation, small variance. And this one has, wide variance, but they have the same mean return. Now, if between the two, if they have the same mean return, which one is preferred? Which stock is preferred? Blue stock or the red stock? Huh? Can anyone tell me?
The blue stock, because it has a lower risk.
Yeah.
Only blue one.
Who is this? Safia?
Yes.
Okay, all right. Yeah, of course, because if it were same risk, if they had same risk, of course, if it had the same expected return, it's better to have something with lower risk, right? Because lower, fluctuation in. So what's today? 8/19, and so. Okay, you got 0.25 for, but what about this? Okay, so actually, it looks like this because we treated, the returns as if they are cross-sectional data. We treated it as if, there was no. It's just, data that can happen, random variables that can happen at same at the same time. In other words, in static time or synchronic picture. But actually, it will be like this. I mean, because over time, what happens is over time, because if we put it in timeline, it will look like this. This is the mean, right? This is the mean, and this is like this is the outlying area, right? The highest and the lowest. This is basically if you put this is put like as if they are, as I said, this is not timeline. This is completely not considering the timeline, but if you put it along the timeline, it will look like this. And of course, you might wonder, so earlier it was high and later it was no. It could be it could be like this too. It could be like this too. But the thing is, this is how it looks. Basically, the fluctuation of the stock price would look like this, right? But let's take another example. We understand this one is preferred, but then what if they have different mean? If they have different mean, what if they have different mean? Now the red stock, let's say stock A, has lower mean, and smaller variance, whereas stock B has higher mean and higher variance. How do you know which one is better? How do you know?
I would go with A because it doesn't deviate as much.
Yeah,
So it's more,
but then that's
less
like,
risk.
yeah. If you are a risk averse person, you would go for this, right? If you're risk averse, but then will you ignore the higher expected return? Can you ignore higher expected return?
Yeah, because it's higher risk.
Yeah, but that means the higher the risk. I mean,
The higher the
you're
chance of
saying
the return.
you will ignore stock B because of higher risk. But then, as the old saying goes,
Bigger
no
the risk, the
pains, no
bigger
gains. The higher the risk, the bigger
bigger
the
the payout.
risk, the bigger the return. That's what it. Of course, that means you have to run. You have to run higher risk, but there is a chance that you will get higher return,
And higher
right?
loss if it doesn't work out.
What?
And a higher loss if it doesn't work out.
Of course. But that's the price you have to pay. You understand? That's
Yeah.
the price you have to pay to win big. But again, so how do we determine? I mean, so you can consider this as bond, and bond has very small variance. Bond has almost, I mean, especially AAA bond would have almost a negligible variance in yield, right? But of course, if it is triple, let's say C bond, and it could be as risky as relatively safe stock, right? Stocks to have way higher risk. So that's why in your portfolio you must have some bond, you must have bond and stocks, and you must have risk-free asset. The composition of your portfolio must include risk-free assets such as treasury and uh, uh, relatively less risk-free asset and risky asset. And risky asset falls into bonds and stocks, right? And bonds are risky, but relatively way less risky than stocks. So then how do you? No, I mean, no number is given here. No numbers are given here. But one thing we can do is Was it here? Was it here? I think it was here, right? Um, so let's take a look at the this example, right? So I told you uh, um, standard deviation is the risk. And what is the return? That's the reward. Reward, right? So think about it. It's like, in a way, it can be compared to a gas mileage, right? What is gas mileage? We know what gas mileage is. It's not a big. Um, and I already talked about this before. Think about it. Um, it's a matter of efficiency. Efficiency. Gas mileage is a very good example of efficiency. Why? Because the higher the gas mileage, the more efficient the car is. Isn't that right? Because for the same gallons, same number of gallons of gas, same gallons of gas, the car that gets more miles, right, is the most efficient, right? The most miles per the same amount of the same gallons of gas. That's the one that has the highest mileage, and the one with the highest mileage is the clearly the winner, the most efficient, fuel efficient, most fuel efficient vehicle, right? So, if you think about it, the gas is your price, the cost, right? The price you pay, right? Like if your car to fill the tank, to fill it, let's say it's uh, whatever, $60 or whatever to fill the tank, 30 something, whatever. But anyway, that's the cost you have to bear, right? That's the cost you have to bear. And for that, the miles, that's the reward, that's the return. So think about it. Suppose you selected three stocks, X, Y, and Z, and their mean return, expected return, is individually 25, 30, 10%. And um, if you have, $1 million, and if you need to allocate $1 million into X, Y, and Z, uh, which one will you allocate most money? Huh? Obviously, you will try to allocate most money into Y because it's got the highest expected return, and then into X, right? Smaller amount into X, and the smallest amount into Z. But that's not the only thing you have to uh, consider, because that's the reward. But what is the risk you have to take? In other words, this is the cost you have to bear. But then X has the standard deviation of X is 40%, 60%, 15%. Obviously, the higher the risk, the higher the return. Smaller the risk, the small. But then think about it. How would you prioritize it? Well, it's how you do the gas mileage, right? It's how you do the gas mileage. It's about the efficiency. Which one is the most efficient? You'll have to divide, right, the return by risk. You understand? Just like, gas mileage. These are the miles and these are the gallons. Then what would you do? Just like gas mileage, you would. So that's called, return risk ratio, or reward risk ratio. Return risk ratio. Also called, mean variance ratio. How come this is mean? Yeah, that makes sense. Expected return is mean, but this is standard deviation, not variance. Isn't variance standard deviation squared? Yes, true. But because they are like, standard deviation is the square root of variance, and variance is simply the square term of standard deviation. Basically, the idea is pretty much the same, right? So we call it, mean variance ratio. To make it really mean variance ratio, right? Of course, then we'll have to uh, Oh, that's not right. This is, a sigma squared means variance, and this has to be a return. Come on. This is mean variance ratio. Okay, that doesn't look like R, but that's fine. Close enough. So then by taking our where was that? And by taking our mean variance ratio, then we can prioritize. The higher the mean variance ratio, that's the best. And if you think about it, this is a safe stock, least risky, but the mean variance ratio is highest, right? And so this is our preferred stock. Right? This is our preferred stock. And this is our second best stock. And this is our third stock, right? So if we rank it 1, 2, 3. And the textbook, the book is talking about the coefficient of variation. And what is that? Coefficient of variation is the reciprocal of mean variance ratio. Uh, so sometimes, this it could be counterintuitive. Why? Why would you do the inverse mileage? I mean, think about it. Coefficient of variation is like the inverse mileage, and the inverse mileage is, in the U.S. we are so used to the mileage being, miles per gallon, right? Uh, and it's more appealing because it's intuitive. But then in most other countries, they use inverse gas mileage, and you might wonder what? Yeah, but if you have traveled around, you would know in other countries they do liter per kilometer. They use liter per kilometer. So how many liters? It's actually not even 1 liter. It's like 0 point something liter to get 1 kilometer. And 1 kilometer is this is uh, one kilometer is about 70% of a mile. I mean, you can divide, uh, 1/1.6. Okay, because 1 mile is 1.6 kilometers. So 1 kilometer is a much smaller distance, and I believe everyone knows that. But there's a funny joke. In the desert, right? This guy is, stranded in a desert, so he's very thirsty. He needs water, and there's a sign. There are two signs. Water, uh, uh, 1 mile. 1 mile, that direction, there's water. And another sign says water, 1.6 kilometers. 1.6 kilometers, water. So actually, if you're a sensible person, you already know, oh, it's the same distance, whether you go 1 mile that way or whether you go 1.6 kilometer that way, there's water. It's the same distance. But most Americans will just go for, 1 mile because they automatically think 1.6 kilometers is greater distance than 1 mile. That's a joke, but, because Americans are so um, unknowledgeable about the things outside, U.S. But in the rest of the world, so that's why I'm saying, in the rest of the world, um, they use, inverse gas mileage, and you will scratch your head, why? It's counterintuitive. But if you think about it, if you are in, if oil, the petroleum, if petroleum is rare commodity in your country, and if you most of the world in most of the world, the countries are not, there are only a handful of countries that produce oil, and oil is a natural resource, of course, that is not found, everywhere. So countries that have to import oil, right? For them, yeah, gas prices, gas is a precious commodity. So they are more keen to how much liter is being used to go 1 kilometer, right? So most of the European countries, South Korea, Japan, they all use. I don't know what they do in China, how but most first world, industrialized world, other than U.S., they all use inverse gas mileage. So if you use inverse gas mileage, then the lower the number, the better it is, because the less gas you use to cover 1 mile, it's better. So still, if you do the inverse gas mileage, still the ranking, this is the most preferred, because the lower the number, the better. Still the same ranking. Okay, so this way you can, using mean and standard deviation, you can select stocks, and you can basically, when you select the stocks, out of when you do the research, what stocks am I gonna pick? Well, basically do this mean variance ratios, and the ones that have, of course, first you will have to do find all the mean returns, and the ones with the highest mean returns, you if you're selecting 5 stocks, the high, top 5, in terms of return, and then out of these, 5, and look at their uh, standard deviations, and find, mean variance ratio of all of them, and then you can prioritize, right? You can put them in, right, your portfolio, and according to that prioritization, then you can allocate the weight. $1 million will be allocated. Here, I just, mechanically, this is a mechanical way of allocating it. It's called, rule of 68 or something like that. It's simply, adding up all these digits, and it's going to be 6. And from 6, 3 over 6, 2 over 6, 1 over 6. This is, of course, 3 over 6. This is 2 over 6, 1 over 6. And you allocate $1 million that way. Of course, that is not necessarily the best allocation. Of course, in Finance 300 investment, you will learn how to how to achieve optimum weight allocation, weight distribution. But for now, then the expected return on this portfolio will be the weighted average of these individual returns. So simply, it will be weight of X times, right, return of X plus weight of Y times return on Y, and weight of Z times return on Z, and that will be weighted average. And in this case, it's going to be 18.33. Okay. So that's one thing you can, that's why, that's fundamental, really fundamental. Nobody, it's indisputable. Nobody can argue with the solidness, right? The solid rationale behind it. The next thing is we're going to be, we're going to come back to this a little later, and then I don't know if you have time to come back to that, but so then how do we value the stock? Stock valuation. Now, because we know how to value the bond, so we want to find the rational price of the stock. And the whole idea is, look, why did we do the rational value? Why did we do the valuation of the bond? Because we want to find it's basically equilibrium pricing, equilibrium valuation theory, because market is normally not in equilibrium. I mean, in the short run, of course, in the short run, it's not in equilibrium. Why? It's not in equilibrium. It's in disequilibrium. And of course, why? Because in the short run, I've been telling you, it's the noise that moves the market. Noise. It's all noise trading. Noise, noise, noise. People are not that rational in the short run. Um, and in case of bond, look, in case of bond, the random factors are very limited. There aren't that many random factors, other than that's coming from the like there's a Federal Reserve is going to taper the bond buying policy. In other words, they're going to shrink the expansionary monetary policy, something like that. But this is already well communicated. I mean, if that's but in case that's pretty much the only thing that affects the random factors that will affect the bond. Otherwise, bond, in case of bond, cash future cash flow is quite obvious, right? There's no unknown in the future cash flow stream in case of bond, because it's all the coupons are already fixed. Coupons are fixed, and then par value is fixed. So there's no random thing. But in case of stock, the cash flow in case of stock is the dividend. I mean, of course, you might wonder, why only dividend? Don't we have the future value of the stock when we sell it? Yes, we do have future value of the stock when we sell it. But again, stock doesn't have any end date, end point. You understand? Stock doesn't have any end point. In other words, stock is, a bond is an annuity, isn't it right? Bond is an annuity. It has maturity. It ends at some point, but stock doesn't end. The only, I mean, think about it. As long as Amazon goes on, as long as this world goes on, and as long as Amazon goes on, or Apple goes on, who knows? Amazon may, go out of business, maybe in 200 years, 300 years, but that's beyond my lifetime. I don't know. It may or may not. It may go on. I mean, because it's already a industry giant. I mean, nothing is more bigger than Amazon in terms of its uh, revenue. I mean, revenue of Amazon is bigger than Walmart. So Amazon has been the revolution in the retail, not only in retail. I mean everything, and Apple, in terms of its asset size, Apple and Amazon pretty much similar. I my understanding is I'll have to check, but Amazon and Apple, they are both $2 trillion companies, and that's the value of the market value of the equity alone. Equity. It's called market capitalization. Market capitalization. With its debt together, it will be, of course, much bigger than 2 trillion. I mean, if 2 trillion is just the simply the market capitalization, but who knows? But if Amazon or Apple don't go out of business, they go on forever. But one day when God forbid, I don't want to see that day. But when just like Elon Musk says, we might have to be a spacefaring race, right? The uh, Earth will live out its life. I mean, nothing. There's no more. Earth will be a doomed planet, and then so we have to Jeff Bezos has already uh, launched. They already have a plan to move to Mars. Elon Musk. Look, what if one day that happens? So then I don't know if Amazon and Apple may still be there. Then uh, uh, are they gonna still do business? Maybe in Mars again. They will. uh, but let's say we fail to become a spacefaring race, and we cannot move to another planet, and we are doomed on this Earth. Well, that's the day the stock will end, because when the Earth ends, the stock will end. But that's in infinite future. That's almost into the infinite future, right? So on that day, on that doomsday, that will be the final price, future price of the stock, right? So even if it is, there, how do we know? I mean, we don't know. And even if you know, it will still be some finite number, right? It's not going to be an infinitely large number. Why? You think, in 200 years, stock price will be, Apple's price will be, like tens of thousands of dollars. Do you think? Huh? In 300 years, will Apple's price will be like, $25,000, or, huge number like that, or, $100,000? Hmm? Anybody? Can anybody
Maybe not.
try those numbers? Yeah?
I mean, I
No,
guess it depends
actually,
on what's going on in the world.
no, it doesn't depend on what's going on in the world. Regardless of
Because
what's going on in the world, regardless of what's going on in the world, the price won't go up like that. The price will still be a finite number. Of course, like $100,000 is still a finite number. But think about it. Didn't you see yesterday and the day before yesterday, I showed you the price history of Apple? There weren't multiple splits. If Apple didn't split from the day one, Apple's price might be, like thousands of dollars by now. But why did they split? Huh? Why did they split?
to make it
The
affordable
most
for other people.
Yes, that's right. To make it affordable, not just affordable, that means more marketable, to make it more marketable. If the price becomes too high, it becomes less and less attractive and less liquid. It loses liquidity. Why? Suppose Apple is $3,000 now, $3,000 now, and I have only $5,000. How many shares can I buy? Only one, right? Remaining $2,000, I cannot buy another Apple, right? But and so I'm holding on to just one share of Apple, and let's say I need $1,000 urgently. I need to cash out $1,000. How do I cash out $1,000 from one share of Apple? Well,
Sell it.
I can conveniently sell one third of my share, isn't it right? I'll have
Hmm.
to sell that one share and cash out $3,000 for that just $1,000 that I need. So is it really meaningful? Is it really useful to have a very high stock price? No. Uh, and besides, if it is like $3,000, even if I want to sell it, it becomes less marketable because people who have only like $5,000, they they will face the same problem as I will face, right? If they have only one share of Apple and they need only $500, there's no way they can cash out only 500 out of 3,000. You understand? In other words, that's not very convenient. If Apple is just $100, let's say Apple is $100, with $5,000, I can buy 50 shares, right? And if I need $1,000, I can only sell 10 shares, liquidate it, turn it into cash, still keep $4,000 in Apple, 40 shares, right? And if Apple grows, you know, Apple grows at 3%. That's what you saw last 5 years. Apple grew 3 point something percent monthly on average. So think about it. You keep it there 1 year. 1 year, if you keep it there, and so $100 times 1.03 something raised to 12. That's how it's gonna grow in 1 year. And you want that, and you also want you want that capital gain, and you also want the convenience of liquidity. But then uh, should a huge stock price, will it help? No, it's not gonna help. It's rather gonna be a deterrent, right? So that's why the stock split. And I'm just surprised. I'm wondering why Amazon isn't splitting. Amazon is like 3,000 something. It was because I don't own Amazon, and the last 6 months ago, I think not even 6 months ago, Amazon was 2,000 something. Of course, it is. Let me quickly check Amazon. I have Amazon. Yeah, I had Amazon there before. So it's 3,000 something, right? Let me turn it into that's daily. See, that's 5 years, I believe. No, let's try maximum and then annual. So Amazon went public in the beginning of Amazon was 1990. This is 97. Yeah, Amazon went public in the 97. So it's about 26 years. It's been 25 years, right? 2021 now. So minus. And then Amazon was, there was no split all this time. And it was even last year. I mean, when was it? Amazon took off pretty much, see, steep incline started somewhere around. I mean, it was just quiet until 2014, 2013. It was relatively flat, right? The slope is flat. But from 2014, and the slope became, very steep. And it's very steep here. And 2020, it hit 3,467, but it's annual. So there was a time when Amazon was in $2,000 range, and let's say 5 years. Look, 5 years. Monthly. Generally, it was this was 2,000 something, right? And that was this is when. Yeah, even June of 2020 and January of 2021, January of 2021, it was already in $3,000 range. So look, and in the history of Amazon, it never had any split, never, and I don't see any dividend, right? I don't see any dividend paid, so that's why it is, like 3,000 now. But Amazon will have to split at some point, right? Because um, uh, to make it more, marketable. Uh, but anyway, the idea is, yeah, think about it. The reason, basically, valuation of the stock is the same thing. It's discounted cash flow model. Discounted cash flow model. You understand what that means, because bond valuation is basically, discounting cash flow, right? Stock valuation does the same thing, but in case of stock valuation, cash flow is dividend. So it's called dividend discount model, DDM, which stands for dividend discount model. But then once again, why the future value of this? Again, because there is no end point for stock, right? The timeline doesn't stop. No, there's no maturity. So even on the doomsday of the earth, let's say Amazon, it won't be like millions of dollars. It will still be a finite number, like some $1,000 or several $100. Whatever that is, whatever that number is, even if it is $1,000,000, still a finite number. Now, that price, the final price that will, which will be the price on the doomsday, the final day of the earth, and then which may be in millions of years, you discount it to today. If you discount it to today, what does that? What is that? What is that? Does it have any meaning? Is it any significant number? If you discount it, like a final price of Amazon, right, in million years, right? If you discount it to today, does it even be any number? I mean, does it be any significant number? Hmm? It's,
No.
it's no, it's not going to be any meaningful number because that any finite number, and you are discounting it like millions of times, discounting it millions of years. Any finite number discounted, infinitely, right? I mean, we don't know. I mean, in infinite time, the Earth will probably end, and if Amazon is still around by the time, the stock price will still be a finite number, but it will be discounted infinite times. It will be close to zero. It will be insignificant. That's why the price drops out from the calculation, from the formula. Okay, then it only becomes, and maybe another slide, because in the other slide, uh, of course, if it is just one period, if it is just, you understand, this is basically return. You understand this is how the return is calculated, right? Um, Capital gains and dividend. But of course, dividend is only paid, quarterly. So that's why, and some stocks don't pay any dividends. So that's why we use, adjusted close price, and then we get the return. And K stands for cost of capital. Remember that was what we talked about at the beginning. K, cost of capital. So return on the stock, return on equity, return on the stock is called cost of equity, right? Cost of equity. Yield, or the return on the bond, is called cost of debt. Okay, but The point is, if you solve this equation for P, um, we can solve this for P, right? Then uh, it will look like this. If you solve that equation for P, it will look like this. But then this is just one period, suppose we extend it to infinite periods, right? Then there will be sum of all the dividends, right? Divided by 1 plus k raised to n, infinitely, right? And then, this one will drop out. Price at infinite future will drop out because when discounted infinitely, if it is discounted infinitely, then it becomes, nothing, close to zero. Okay? So that's why it, eventually boils down to a simplified formula. And there are actually in stock, there are four different valuation models, four different valuation models. And they are not unrelated. They are all related because, one is tweaking of the other, right? It's simply tweaking of the other. Um, so first, there is a constant dividend model or zero growth model or perpetuity model. Constant dividend means, dividend doesn't grow. Dividend is constant, right? So there's no growth in dividend. That's why it's called zero growth, right? Zero growth. And it's also called perpetuity. Why? Perpetuity is what? That means infinite, perpetual annuity. Perpetual annuity. Perpetuity literally, goes on forever. Now, you know what annuity is? Annuity is like bond. It pays fixed amount, fixed constant, regular amount at regular interval. Yes. Just like that, dividend is fixed in this case because it grows, it doesn't grow, zero growth, it's constant. So it is, like annuity, but it doesn't have any end. So it's perpetuity. If it is perpetuity, it boils down to this model. Now, this S0, that's stock price, right? Rational price of the stock, right? At time zero, right? So it's like B in bond. Second model is constant growth model. And constant growth model is actually the opposite of constant dividend model. Why? Just because it is, some students confuse, oh, they are constant. But, you're not thinking, if you're just because, the word is constant, if you think they are, similar, no, they are actually opposite. And if people don't analyze, right? If you analyze and interpret and analyze, then you know that they are opposite. Why? Constant dividend means that dividend isn't growing, but constant growth model means dividend is growing at a constant rate. And if that's the case, this is the formula. Okay, dividend at time t plus 1 over r minus g. Okay, and then there's variable growth model, and the variable growth model has to go through several steps, at least 3 steps, several steps. But the but variable growth model assumes, of course, in this case, dividends growing at a constant rate. So that means companies growing at a constant rate. But, and companies' profit is growing at a constant rate. But is that realistic? No, it's not realistic because companies, all, businesses go through cycle. And, you might say, oh, yeah, it's not because it's fluctuating. No, 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 no. There is, cyclical, there is, cyclical fluctuation, seasonal fluctuation. Um, but we're not talking about the seasonal fluctuation. If it is a seasonal fluctuation, um, the average, we can find the average growth rate. I mean, um, no growth. You remember the house value example? The house value grew eventually over 10 years. House value grew. You understand? You remember that? House value grew, right? Overall growth over 10 years was like, from $150,000 to $500,000 or something like that, right? The house value. But, there were fluctuations, right? House values, sometimes dropped, sometimes, went up and then, dropped again. That is like, seasonal variation. It's not, in that example, it's not really seasonal uh, eh, because, it was like 10 years. It's rather cyclical because of business cycle, cyclical. Um, because of the business cycle, right? But then, even if it is cyclical, due to business cycle, you can still find, average growth rate of, although dividend growth rates may be uneven, you can still find average growth rate. We can still use, constant growth model. But a variable growth model assumes, variable dividend growth rate. Uh, but that doesn't mean fluctuating growth rate, like wildly fluctuating growth rate. In other words, it's not like crazy, goes up, growth rate goes up, goes down, goes up, goes down. No, not like due to business cycle, but because of the industry life cycle or product life cycle. Industry life cycle or product life cycle. So it's not like fluctuating pattern. It was like first fast growth and then steady growth and then flat, right? No growth and then negative growth, right? It's all because of the industry life cycle. And then fourth is free cash flow model. So in variable growth model, you will need to eventually, constant growth model will go in there. And free cash flow model is simply an application of a variable growth model to a situation where there is no dividend. Okay? Because I've been telling you, dividend is not an obligation. Companies don't have to pay dividends, right? Because anyway, and dividend is mainly, a signal, right? Uh, because of a signal effect, And though I introduced dividend, irrelevance theorem before, because whether the dividend is paid or not. Anyway, it comes out of the profit, right? Dividend is paid out of the profit. So eventually, it's the same thing, whether they pay dividend or not. Uh, if they pay dividend, the book value of the stock will go down. So if uh, what you received in dividend is just the part of the profit that you could have got by selling the stock uh, if they didn't pay dividend. Okay, but as they paid dividend, uh, part of what you could have recovered by selling the stock was paid in dividend, and the remainder after paying dividend, uh, the price that adjusted after paying dividend, so price must have went down. If you sell it, you get lower price. So add what you received in dividend plus the uh, proceeds that came from selling the stocks. If you add them up, it will be the same thing as if you sold it uh, without receiving dividend, right? So that's dividend irrelevance theorem. Um, But since dividend is not a must, right? Companies may or may not choose to pay dividends. Um, what if, how do you, and stock valuation model is basically DDM, dividend discount model. What does that mean? Um, you have to have dividend data. Otherwise, you can't. That means if you don't have dividend data, uh, no valuation is possible, right? So if the company doesn't pay dividend, how do you value them? Then we have to use free cash flow model, right? And then free cash flow, um, even the company that doesn't pay dividends, uh, we can extract free cash flow uh, from financial statements, right? We can extract the data, from we can. So it's a tweaking. It's an application of also variable growth model. So with let me okay. Here's the example. I mean, I put a couple of examples here. First, um, is this the zero group? The most recent. Oh, this is. Where is it? Xylon Corporation's stock is selling for $48 a share, according to the Wall Street Journal. Okay, price is given already in this case. The Wall Street, we've heard a rumor that the firm will make an exciting new product announcement next week. By studying the industry, we've concluded that this new product will support an overall company growth rate of 20% for about 2 years. After that, we feel growth will slow rapidly, and even this is variable growth model example. So this is not the. We'll start looking into constant dividend. Uh, if a stock is expected to pay a constant non-growing dividend, it's called a perpetuity, and also there are preferred stocks. Did someone say something? Okay.
I don't think so.
Okay. Maybe it was my voice being echoed back. Um, and preferred stocks generally pay flat dividend, fixed dividend. Details are hidden while you share your screen. I don't. Okay, but as long as you can see what I'm looking at, I think there's no problem. What is a preferred stock? Preferred stock is, there are, mostly when we say stock, it means common stock. When we say equity, it means common stock. But also preferred stock is also equity. But preferred stock is like a half equity, half debt. It's not really debt, but it's like it's still equity, but it's got the some features, a common feature with what's a common feature? Like interest payment. Interest payment is fixed. Coupon is a fixed payment, isn't that right? And dividend is not dividend by default is not a by its own conception, by its own birth. Dividend is not a fixed payment. Why? Unless the company's profit is constant, right? But the company's profit is bound to fluctuate, isn't it right? Company's profit is bound to fluctuate. Of course, in the long run, if it will show uptrending. It will show uptrend, right? Upsloping trend. And not every company will show upsloping trend, but such a company is doomed already. But if a company, usually growing company will show definitely rapidly upsloping trend, the profit of such a company, and then but because dividend is basically a small fraction, a percentage of that profit being paid out, right? So think about it. If dividend payout ratio is 10%, then that percentage but depending on percentage is a fixed number, but profit changes. So 1 year, one year, uh, profit was 10 million. So paying out 10%, it will be 1 million will be paid out as dividend. Another year, profit is 20 million. 10% will be 2 million, right? So basically, dividend is bound to fluctuate with the profit level. But then in preferred stock, uh, it regardless of the profit level, they just paid fixed amount. So that's like a coupon, right? In that sense, it is like uh, in the sense it's like a bond, right? But unlike bond, it doesn't have maturity; it goes on forever. But then it doesn't depend. So even if the company makes huge profit, in very good years, you don't get, you just get fixed. But then why do they have this kind of stock? It's called, and why is it called preferred stock? Because it's called preferred stock. It looks like, sounds like it's something better. No, it's not better. But it's better in terms of risk, isn't that right? Uh, if you have common stocks have, uh, you may not receive any dividends. You may not receive any dividends. Uh, Depending, if the company is not doing well, you may not receive any dividends, and even, you will have capital loss because, your stock will be now selling at a lower price, so you lose, there will be a capital loss. Uh, but in preferred stock, uh, that variance is very much smaller. The variance is much smaller. Of course, since it is equity, if the uh, company goes down, of course you lose your equity. But until then, you at least you have fixed amount of income stream. So preferred stock and common stock, with the common stock, you have voting right. Voting right means ownership, although you don't exercise it, because as I told you, I'm although I'm Apple shareholder, Berkshire Hathaway shareholder, I never get. I can exercise my vote, but I never get invited to the general shareholders meeting, right? To exercise my vote, I have to actually register to get the ballot, sent to me, or I go there. I'll have to fly there, to the general shareholders meeting. Of course, you have to register first, and then you may register there as well, but then you get the ballot, and you get. But then again, it's not it's indirect democracy. It's like indirect democracy. Uh, uh, you can't you can vote for directors, but you don't vote for the chairman or chairperson, because the board of directors will vote for chairperson or the chair, whoever. Anyway, the idea is um, common stocks are true ownership because it comes with the voting right. Preferred stocks don't come with the voting right. There's no voting right with the preferred stock. So then why? Well, suppose think about it. The current majority shareholders, the current board, in other words, the current board of directors, who are mainly the majority shareholders, right? and they are basically, the owners. Of course, I can say I'm also an owner, but my ownership. I don't have a stake in that company. For example, someone like Steve Jobs has a big stake in Apple. Someone like Jeff Bezos has a big stake in Amazon. Someone like Elon Musk has a big stake in uh, uh, what Tesla and SpaceX. Um, thing is, these people have like 15%, 11%, 16%. Uh, and with their friendly board members, friendly majority shareholders, friendly forces that they can form a controlling majority. So they have a stake, and they are directors, right? They are directors of the company. Um, they're on the board, so they have stake, huge stake in the company. So, um, but someone like me, I'm not on the board, I'm not one of the directors, and my stake with this company is, Apple or Amazon is just as good as the good return I get. So if I get a good return, and I will continue to hold it, but once I don't, once that's the what I consider to be the best return, and after that it is going to crash, then I will just wash my hands off, right? I will just sell my stocks and wash my hands off. But people like Steve Jobs, uh, Jeff Bezos, Elon Musk, whether their stocks fluctuate, go up or go down, they aren't going to sell, right? Because why? Because um, they are controlling, right? They have controlling stake in the company, right? You understand? So for those people, for those shareholders who controls the ownership, right? Who has the ownership of the company, they don't want um, they don't want their controlling ownership to be intimidated, threatened, right? If they are, if they have controlling majority, but let's say uh, Microsoft has shares of Apple. Apple owns, shares of Microsoft. They cross own each other. They cross invest each other because if think about it, uh, I believe Samsung also has a lot of Apple share. Apple also has a lot of Samsung shares. You understand? So why? Because it's hedging. They're hedging their risk. You understand? If Galaxy and Samsung, I mean Samsung and Apple are competitors. Samsung is more broader, much in a broader range of they are not only making phones, general they are in electronics. All they have TV, they have not only phone but computer. They make computers. They also make refrigerators. They make a lot of they make washing machines, washers and dryers and dishwashers, a lot of electronics, and then they even have automobile. They are separate companies, but all under the umbrella of Samsung. They have also, in it's a conglomerate, meaning they are in all different industries. Of course, Samsung's, share that Apple owns must be only Samsung Electronics that makes Galaxy, right? But the reason they cross own each other is, to benefit from, I mean, because they are competitors. Sometimes, Apple will do better. Sometimes, Samsung will do better. I mean, Samsung puts out new models that are, very hot, and market share. I mean, some of the Apple iPhone users may switch to Samsung new foldable phone or whatever. Then if Samsung, grows, and and Apple will suffer, but from Samsung's owning Samsung's stock, uh, they will not suffer that much. They will not, at least the loss they made from their sale of iPhones will be partially offset by Samsung's, driving Samsung's profit, right? You understand? So they don't, but then Apple will be very, watchful. Apple will put their guard against, Samsung owning more and more of Apple's stock because they can buy from the market. I mean, there are people, if the price is right, there are people who will be willing to sell Apple share, and the Apple share that is being released by these people will be siphoned up, right? Will be all sucked up by Samsung. And what if Samsung reaches controlling majority, right? Apple will fear that. Also, Samsung will fear that too. Samsung will fear what if Apple, owns too much of Samsung's, shares. So common stocks, of course, if you have 51, if you're controlling 51%, if you're controlling supermajority, if you're not selling, right, nobody can, if no matter how Samsung wants to buy supermajority of, Apple, they can't. But because other companies cross-own, and it's also it makes it solid instead of, if even if it's the competitor, right? Even if it's the competitor. Uh, so Coke owns Pepsi partially, Pepsi owns partially Coke, But then think about it. This is equity. As long as they own it, cross-own each other by through equity, uh, the capital structure of these companies will be more solid, meaning less debt. They don't have to resort to debt, right? Of course, think about it. No debt is not a good thing, but too much debt is too much debt is a threat. It's a risk. So think about it. It's instead of raising capital through debt, it's still better, uh, even if it is by their competitors. Still, raising capital through equity is better. But then, if it is equity that doesn't carry any voting right, wouldn't it be much better? I mean, Samsung wouldn't have to fear taking over by, being taken over by Apple, or Apple wouldn't have to fear uh, being taken over by Samsung, right? But still, through preferred stocks, this is possible. They will get equity, right? There's no voting rights, so they cannot, do anything about the ownership control, right? So it's about ownership control, basically. So I told you. So a good example of a perpetuity would be a preferred stock. Preferred stocks generally pay uh, constant dividend, so it's a perpetuity. But even some common stocks can pay, So I don't have, I don't know in the main lecture video if I showed you how uh, this long, actually, think about it. It's a long formula that will. This is just the reduced form. This is just the reduced form, right? Uh, And in the video, I must have shown you how, from the original long polynomial, how it, simply collapses to this. Um, it's not Gordon model, actually. Gordon model. It's not Gordon model that. Um, Gordon model is just another case of, I mean, they all start from the same long, dividend divided by 1 plus r, and plus dividend at time 2 divided by 1 plus r squared, and dividend at time. It's a long polynomial that goes, to infinity. But I'm showing you, actually, I'm gonna show you how a golden growth model is derived. But this is not from golden growth model. So one example, Apex Corporation paid a dividend of $3.50 this year. What are the next 3 dividends if expected? Oh, now this is, then it's a different example. This is not the, but this is going to be an example of rather like, dividend, constant growth model, which is not difficult to understand. Where is it? Zero growth? Where is an example? Where is the example? I think it is somewhere, but it's not a difficult one. Okay, never mind. I don't. So, so it's very easy. I don't need to even use an example. If the dividend was $2, if the dividend is $2 and it goes on forever, so let's make it $20 because it's at least it's a perpetuity. If if this stock paid $20 dividend, and if the required return, this is called required return. Actually, that's the discount rate, but it's called required return. And in case of stock, the required return is all, discount rate is all different across every stock depending on its risk factor. It's not like there is no like double A, single A, triple A kind of class in stock, because you cannot classify stock's risk that way. Stock risk is totally peculiar to each individual stock. So you have to using beta, which which is capturing the systemic return. You have to find required return based on that, and that how you find the required return is called CAPM, capital asset pricing model. And if you're saying, professor, I never knew that, or why didn't you tell? Look, it was all done already before, right? Through the regular lecture. Regular lecture is not this. It's the videos that have been posted already and scheduled, for each day. That's the regular lecture. So you shouldn't be, if you're saying, what CAPM? What is that? Then I'm sorry. That's that your fault, right? If you didn't study those videos, your fault. It's like when you come to class, and in the class, when you are already given, a reading assignment, you read it and come to class, and then you can understand what's going on in the class, right? You can participate in the discussion in class. So you should have read in advance. But if you didn't do that, and in the class discussion, you cannot say, "What, professor? I didn't know." You can't say that. If you say that, it just proves that you are just incompetent, right? It just proves you're just proving that your own incompetency, right? So if you had already followed studied the videos on the assigned scheduled dates, you wouldn't wonder. You shouldn't even say what's CAPM. No. Now So if the dividend is, constant and it's $20 and the required return is 10%, what should be the price of that stock? It's 20 over zero point 0.1, so it's going to be $200. It's, simple. Uh, Next, a constant growth model is, dividend at time t plus 1 uh, over r minus g. Of course, r, this is also called, this is also sometimes written as k, and that's, remember, cost of capital. And it's actually KE, cost of equity, which is the same thing as required return minus. So next question is, and this is also called Gordon growth model, Gordon growth. And the Gordon growth model is named after, Professor. There are like among among the economists, famous economists, there are at least two Professor Gordons. Okay, and I forgot his, what, Robert Gordon? I don't know. Not Robert Gordon, but he's already dead because he was, he he came up with this model in 1950s, and he was already in his 30s in 1950s. So he's no longer. I believe he died in 1990s. There is another one who's still alive, but that's not the same guy. That's not this guy who. That's not the guy who made this model. So dividend at time t plus 1 is the next period dividend. And how do we know? How can we tell? I mean, dividend at time t is the most recent dividend. So it's actually dividend at time t is, last quarter's dividend, right? That's known, time zero, right? Dividend at time zero. And then next quarter's dividend, how do we know? Well, if we have past dividend data, we can find the geometric average of the past, dividend data. So that's, growth rate, G. It's not only because it's geometric average, and of course, growth. Remember, growth. If there's anything in growing, right? If there's growth, then you have to take the geometric average, right? So we know we found the geometric average from the past data, dividend data. So by compounding it once, right? The most recent dividend times 1 plus G, and then we have the forecast of the next period dividend. Okay, so the example, let's take a look at that example. Example of, I think this is the Atlas Motors is expected to grow at a constant rate of 6% a year. So it's based on the assumption that it's going to grow at a constant rate. But of course, reality, I told you, I've been telling you, in reality, no growth rate is even, right? And from the house value model, you all know house value grew at uneven rate. But then how did we find our geometric average? It's the geometric average. And geometric average is basically the constant growth rate. Why? Although there actually has been some, fluctuations in growth rate, but the average of that, they grow on average by that constant growth rate, which is the geometric average of all those uneven growth rates, right? So even though in reality, the next year growth rate may be something different, right? Something different from the geometric average, right? Something uneven. Still, there's no better forecast. There's no better forecast of the growth rate than the geometric average, the growth rate we calculated. And so it recently paid a dividend of $2.25 a share. The rate of return on the stock is similar to Atlas, is about 11%. So actually, this is using a very simplified or simplified assumption. because actually to find the required return, we must uh, use CAPM, but that's another step. So what do they use as the required return or discount rate? Something similar to Atlas. The rate of return on the stock similar to Atlas is about 11%. So this is like a AAA, bond rating concept. You use the rate of return of a company that is similar, comparable to this company, right? And comparable meaning, in the same industry, and then uh, similar, market capitalization rate, similar capital structure, similar total asset size. I mean, if the total asset size is too different, then it's not, the candidate. Something with similar total asset size, and also something with similar capital structure, meaning, composition of equity and debt would be similar, right? So, and then you can find rate of return on, like most recent rate of return of that company, basically what was their profit, what was their equity, uh, uh, or, looking at uh, from the, fundamentals you can find, or from their data. I mean, the price data is available. You can just look up Yahoo Finance and you can, easily download and calculate the return. Uh, So rate of return on stocks similar to Atlas is about 11%. So then we use this as, the discount rate of the required return of this company. And this concept is, why are we using the required return? Why are we using the rate of return of another company, a similar company? Now, the reason for that, the rationale is the opportunity cost. Right? Suppose you have, $10,000 and you want to invest in Atlas, but if it's not Atlas, you're not sure about Atlas. So if it is an Atlas, where would you put that money in? You will put the money into the next best candidate. Next best candidate. The next best candidate will be a company that is, it could be another industry, company in another industry, but let's say, next best candidate would be something that would be similar, right, to this company, right? So then that's why, because your opportunity cost, the discount rate is basically the opportunity cost of your capital, opportunity cost. If you didn't put this money into this stock, where else would you put it? Remember, in case of bond, if I'm looking into, I'm considering to put my money into this bond of company X, and what's the credit rating of company X? Credit rating of the company X is AA. So if I didn't put my money into this company X, where else would I put the money in? I will put the money into the next best candidate, which would be also in this, like AA category, similar company, right? And that company's return would be my opportunity cost of capital, right? So if I'm discounting it, I'm using that. But in case of a bond, uh, on average, you will get, because if you don't put your money into this company X, on uh, any company in triple B, I mean double A class, uh, on average they will all, if I company Y, um, the yield on company Y will be similar to company Z, or they will, it won't be very much different, because As I said, in case of bond, the the variance is very small. Variance is very, 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 very small. Standard deviation is very, very small. So on average, you get pretty much the same return. So that's why it's called prevailing rate in the market, which means opportunity cost of capital from a company that is similar, right? Comparable. So then I'll just plug it into this model, so we can forecast what it's going to be. 2.25 times 1.06, and then divided by 11% minus 6%. So it comes to this. Okay, that's Gordon growth model. Let me show you how actually. So my question, I was really as a graduate student, I was very curious why suddenly why is it K minus G? I mean, um, you know, zero growth model, it is D1 over K, right, or R. Well, why R minus G? I mean, um, why do we subtract growth rate from the return? I mean, uh, why? Because the return benefited from the growth, so we net out. We just net out the growth rate to find the effect of the pure return. I was trying to I was wrapping my head around it, but trying to verbally, doing a verbal, once again, economics, finance, physics, math, statistics, verbal thought experiment leads to nowhere. I mean, sometimes it may help, but trying to rationalize it and justify it verbally, it takes you nowhere. I mean, I couldn't, get to any conclusion. But one thing hit me. One day, right? What hit me was, I think I put it somewhere here. Was it here? I don't know. Why isn't it? Yeah, I put it here. This is my interpretation of Gordon growth model, how it came to have R minus G at the bottom. I mean, steps of derivation, my own steps of derivation. So first, I thought about this. Well, in one period later, I will have stock price at time t plus 1 and dividend at time t plus 1. Of course, time frame is quarterly, so I mean time unit is quarterly, so between this quarter and the next quarter. So my future stock price and the dividend is the result of my price at time t, growing at 1 plus with the return, right? And not 1 plus R, the rate of return, right? Cost of capital. Yeah, think about it. If I don't have dividend here, think about it. If I don't have dividend here, it's simply growth rate. Isn't it right? Growth. What's the difference between growth and return? Growth means only, growth in capital, so capital gains. I mean, if my capital, which is, PT at time t, right? P at time t, grew to PT plus 1 only, then it's only capital gains. Then this cannot be called K, right? Cost of capital or, return. It should be called only G. You understand? But next period, I will have not only PT plus 1, but also D dividend. So if I divide both sides by PT, then it's going to look like this. And then I can break this up. Literally, PT plus 1 is PT times 1 plus G. I mean, if PT grows by growth rate G, then it's going to be PT plus 1, right? DT plus 1 will be DT plus 1. But I can break this up. I can break this up in two terms. One is PT over 1 plus G over PT, right? And then plus DT plus 1 over GT. Now, think about it. This is going to be, it's going to be PT plus 1 times PT over G, PT plus 1 times PT times G over PT. PT will cancel out, cancels out, cancels out. So it's, this one's going to be 1, this one's going to be G, right? And then I rearrange the terms, 1 and 1 will cancel out, 1 and 1 will cancel out. And I have, dt plus 1 over t in the left-hand side. I move it to the right-hand side, it's going to be minus g because, the sign changes. And if I solve this for only p, then it's going to be dt plus 1 over k minus g or r minus g. I mean, this is a very simple, straightforward mathematical logic. It's simple algebra, but behind it, the assumption of, the understanding that the growth is different from rate of return. Rate of return is more than just growth, right? Because return includes, not only, price at time t plus 1, but cash flow at time t plus 1. And if we understand that, if we can break it into a growth rate and K, then that eventually, that voila, then that's the golden growth model. Okay, now we are out of time, so we cannot do any further. But again, everything is done through the main lecture, right? So that's it for today. And since this is the last day, I want to say, good luck on your final and have a good rest of the summer. I mean, rest of the summer. Fall semester starts on the 25th. So rest of the summer there's hardly a couple of days. But anyway, good luck and take care and best wishes. Okay, best wishes. So I'm signing out and stop recording.
Thank
All
you so
right,
much,
all
Peter.
right.
Goodbye,
You're welcome.
Professor.
Take care. Take care. Take care. Signing